Hi, my name is Sandra Navidi, and I would like to thank you for joining me on the Auditorium Anlagewelt platform today. The title of my presentation is Economic Government Certain Uncertainty, and what I'm going to talk about is how policymakers have changed the world we live in today, and what we can do to adjust. First, I will briefly analyze the status quo, and then focus on central bankers because they have been taking center stage, even though there are many other policymakers, like from the International Monetary Fund and the EU, but central bankers have been taking center stage, and that's why I will focus on them. At the end, I will elaborate on how we can adjust to this new reality. Can you imagine Chancellor Angela Merkel crying and talking about suicide? Yet that's exactly what happened in the fall of 2011. Greece was imploding politically, contagion was spreading, and Italy was just about to lose market access. Policymakers were preparing a rescue package for Greece, and all the senior policymakers came together, among them President Obama and French President Sarkozy, and they were putting extreme pressure on Merkel to strengthen the firewall and to increase the size of the rescue fund. President Obama was afraid that Europe would fall in depression and that would negatively affect the US, tip it back in a recession, and threaten his re-election. Merkel, however, did not want to do further German commitments without any concessions. So tempers flared, voices were raised, Sarkozy lost it, and eventually the usually restrained German chancellor cracked and started crying. What does it tell us when policymakers wait until the last minute, then they shoot from the hip without any clue of what's going to happen, and all of us are kept in the dark? First of all, it tells us that there's a lot going on behind the scenes. It also tells us how dependent decisions are on individuals, and that we only learn about them much later. Although I have to say, in defense of policymakers, they have to maintain a certain amount of secrecy, because if word leaks, then there's going to be a market panic and bank runs, and so that's why they have to keep it, hush hush. Only recently, the former Treasury Secretary Hank Paulson and also Tim Geithner and Sheila Bair, the former head of the FDIC, have come forward. They've written books, they've given interviews, and they've actually disclosed how close the system came to collapsing. And Ben Bernanke recently said that the crisis of 2008 was much more worse than the depression. And all of them said that the financial system is far from stable and that it continues to be susceptible to further crises. So what does that mean for the rest of us? For sure, obviously, investing today is much harder than ever before, because financial, economic, geopolitical crises all at the same time globally are overlapping, and these events all together have caused a paradigm shift, meaning old truths aren't valid anymore, and parameters within which we are used to thinking have changed. The only problem is we can't say exactly where they've changed to, because developments are dynamic and they keep on changing. If it consoles you, many legendary investors even have made one-way bets and lost a lot of money, among them, for instance, Paul Tudor Jones, Louis Bacon, Alan Howard. And their thinking and reasoning, for instance, with regard to the crisis in Europe, was logically consistent, but either their timing was off or they failed to factor in what policymakers would do. And that brings us to the main problem, the political economy. Investments are determined not so much by fundamentals anymore, but rather by what policymakers do, specifically central bankers. Their actions skew the economy and distort markets, and central bankers have therefore become now the most powerful people in the world, in many respects more so than elected officials, because they are independent and restrained by fewer checks and balances than politicians. They now determine the course of the global economy. They have a huge impact on all of our lives, and since the beginning of the financial crisis, central bankers have globally pumped trillions of dollars into the financial system, which means that central banking essentially has become an economy in and of itself, and central bankers or central banks amongst the biggest investors. Considering how complex the system is, actually it's a miracle that no more accidents have happened, because we have the G20, the G7, we have 18 EZ countries, we have 27 members of the European Union, we have the finance ministers, central bank governors, decisions need to be ratified by parliaments, and so on. So And in that, you have to factor in human decisions, the human dimensions. There are always conflicts, there are competitions, resentments, loyalties. But central banks are the only institutions that are able to make quick decisions and execute them. Even though I have to say it's a lot harder, for instance, in Europe than for the Fed in the US. Anyway, but they can act much more quickly than presidents and parliaments, and therefore that's why they have basically been forced into actions. Central bankers regularly see each other. We just had the central bank governors meeting in Jackson Hole. In October, there will be the annual meeting of the International Monetary Fund in Washington. And in January, everybody will get together in Davos again at the World Economic Forum. But most importantly, in between, all the time, they're in constant touch, and they meet every other month at the Bank for International Settlements in Switzerland. Just a word on Jackson Hole. The U.S. has 12 local district Fed banks. Jackson Hole is one of the most high-profile conferences because historic announcements were made there and history made and famous people have attended. And the purpose generally is for them to come together and discuss monetary policies and academic studies, and importantly to have private, off-the-record conversations. They exchange experiences and potentially coordinate with each other. Wall Street attendees this year have only made up less than 5%. It used to be much more in the past, but I think central banks are trying to avoid the appearance of inappropriateness. The meeting of the International Monetary Fund in October is a much different animal. It's much, much bigger. It has 12,000 participants that come in from all over the world. The IMF has 188 member countries, and all the finance ministers will come, the central bank governors also, of course, and people from the EU. And the reason why it's so big is because there's a lot of shadow conferencing going on. A lot of commercial bankers will come, fund managers, think tank representatives, all the big bank CEOs are there, from Jamie Dimon, Michael Corbat of Citigroup, the co-CEOs of Deutsche Bank. Everybody will come there. They hold dinners for clients and cocktail parties, so it's very social and there's a lot of mingling going on. The most important for central bank governors is the Bank for International Settlements. The BIS, as it's called, is essentially the bank for central bankers. And the 18 central bankers of the most economically important countries meet there every other month on a Sunday, come together. Those meetings are completely confidential, off the record, there are no transcripts, and the BIS has a similar status as the UN, meaning as the United Nations, meaning that it's technically not on Swiss soil and not under Swiss jurisdiction. Central bankers in general have a rather rarefied existence. They're a small, tight group of people, very homogeneous. Almost all of them are male, they're very academic. I find them to be a rather friendly, unpretentious, approachable bunch. But they have to be a little guarded because they have to be very careful of what they say. They're pretty much on the same wavelength with each other, they communicate on the same frequency, and many of them throughout their lives have been interconnected. To give you just one example, Stan Fischer, who was the central bank governor of the Central Bank of Israel and now is the second in command at the Fed next to Janet Yellen, used to be a professor at MIT University in the United States, where he was a professor to Ben Bernanke and Mario Draghi. So they all know each other. That's just one example, but they all have, had personal relationships for a very long time. They're all very passionate about economics, and I feel they have a sincere desire to help. They're also constantly on the alert because of the ongoing crisis, so it's a rather stressful job. And I also feel they have been getting a bit of a bad rap as abusing their printing privilege, when all they were trying to do really is to make up for the inaction of politicians who did not move on structural and financial reforms. So central bankers were just trying to build a bridge of time, and of course it's a tightrope walk for them, and we can never be 100% sure that they did the right thing because it's impossible to know what the alternative would have been. But I think the consensus now is pretty much that the financial system would have actually fallen off a cliff if they had not intervened. So if we want to be mad at anyone, we should actually be mad at our politicians. Central bankers, if they make all these wide-ranging decisions, do they at least know what they're doing? There are some people who fear and others who hope that central bankers, particularly the Fed, have superior knowledge and that they're somehow part of a secret club that is pulling the strings of the global economy behind the scenes, but that is not the case. Most of the time, they don't get their predictions right. Former Fed Chairman Ben Bernanke recently said that economics is great at explaining to what past mistakes were made, but the predictions of the future were not so good, and that at best the analysis can help prevent the worst mistakes. I guess that's what's called expectation management. To put this in perspective, though, generally predictions, whether they are made on the public or private sector, have also been notoriously incorrect. More than a decade ago, the International Monetary Fund published a survey on the accuracy of economic forecasts, and the conclusion was that, first of all forecasts are pretty much the same, very similar, and almost all of them were wrong. Particularly impending big changes, which one would think are easier to detect, like recessions, were mostly missed. So even the most thoroughly researched forecasts turned out to be not much better than guesswork. The same thing applies to central bank forecasts. Even though they have best access to data, they work with the most accomplished economists, and they have sort of a bird's eye view, their forecasts have also been flawed. And you can tell how difficult the interpretation of data is by the way that various Fed governors come to diametrically opposed conclusions. Take, for instance, unemployment. The Fed is not entirely sure on how to interpret the data and whether the persisting unemployment is more of a temporary cyclical nature or if it's more of a permanent structural nature. And even if it's the former, more of a temporary cyclical nature, and persists long enough, whether it will turn into longer-term structural issue. This is all very unclear. And since central bankers don't know exactly what the state of the economy is, they have to do a risk-reward calculation. On balance, even though I would say the Fed in the US is dialing back easy monetary policies, I feel that the tendency at this point is still pretty much to be supportive and help the economy, particularly in view of the lack of action by politicians, which is very similar in the US as it is in Europe, though for different reasons. Currently, the most crucial issue is whether or not the Fed should raise interest rates. Obviously, none of the Fed governors knows exactly what is going to happen when they do raise interest rates, and they always have to factor in unknown knowns, unknown unknowns, and the law of unintended consequences. So something's always bound to go wrong, and they have to be prepared for that. Also, the Fed has been trying to be more transparent, to give the market more guidance in order to provide stability and avoid surprises, but that has backfired because the Fed says that what the Fed says and what the market hear are not always the same thing. So what should we make of this? First of all, there is no conspiracy theory. The reason why people make up conspiracy theories is because we as human beings dislike uncertainty, we dislike randomness, and especially we dislike a lack of control. And so when events happen that have no obvious explanation, people are trying to connect the dots and create a narrative that makes sense of what happened. Conspiracy theories can be amusing and they have entertainment value, but I find them mostly annoying because conspiracy theorists assemble facts in a way that corresponds to their worldview. It's never corroborated by any proof, and so they spread a lot of misinformation. That's what I feel is dangerous because they're dumbing down people and because they're distracting from the real problem, and with their misinformation they obfuscate facts and therefore prevent finding solutions. Case in point, for instance, the theory that the US is trying to destroy Europe economically for its own benefit. The US has by all accounts been very supportive, and when I talk about this, I'm taking specifically out American people, but people of other nationalities at the IMF or at central bankers who were actually involved in solving the crisis have all said that there was a lot of initiative, a lot of pressure coming for the US, for Europe to get their act together. To an extent, actually, that I've heard from Germany, it was perceived as unwelcomed interference. An example would be when the euro almost came apart for the first time in May 2010. Greece was about to implode and the crisis threatened to spread to Portugal and Spain. And because of that, the world's most powerful policymakers came together in a secret emergency meeting. It was a race against time. It was unbeknownst to the public because they were frantically trying to find a solution before Asian markets opened on Monday. Because if they hadn't come up with a solution, they feared that it would have led to a domino effect that would have caused contagion across global financial markets and led to a crash. And that's when they actually created the $750 billion rescue package. And the reason that came together last minute was because the U.S. took a very active role in pulling all the various parties together over several meetings to come up with a solution. Secondly, we cannot predict the future. The future is uncertain. It cannot be modeled with mathematical models because we cannot connect the dots going forward. We have seen this in the crisis of 2008. Risk models were used based on past data, and nobody foresaw that they would all blow up at the same time. Because of increasing interconnections, of technical innovation, and the speed of events, the world has become much more complex. The closest thing we can do to predicting the future is perhaps to devise different scenarios and assign odds, and also possibly determine very short-term or very long-term events. But it's generally difficult because events are non-linear, human decision-making is not a linear process, and it depends on many variables. That makes it rather unpredictable. Thirdly, it's not so much what we think, but how we think. First of all, we must mentally equip ourselves to better deal with uncertainty to prevent premature decision-making. If there's one thing that is certain, is that uncertainty is not going away, and we as human beings have an innate intolerance of uncertainty. Research has actually shown that we prefer to get negative news, bad news, rather than endure the condition of uncertainty. And this intolerance typically leads to premature decisions. Another thing that we need to guard against is biases, more uncertainty, and at the same time we have an oversupply of information, and in order to process information and unfamiliar scenarios, we use biases, meaning essentially prejudices, as mental shortcuts. We filter information through our past experiences, through reference points that are familiar to us, and our worldview, and we tend to believe that which confirms our beliefs. Therefore, we tend to overestimate our ability to be objective, and through the way that our brain is wired and that it has evolved during evolution, we have developed various different biases. For instance, if I believe the financial system will collapse, then I will lend more credence to reports that have entail more negative news, and I will be more dismissive of optimistic news. So this is called confirmation bias, but there are several different biases like optimism bias, negativity bias, and so forth. So what are the takeaways? Finance is a complex system. There is no central control, and because it's a complex system, it's even more important than before to understand the system in its entirety. Since the system continuously is evolving, there are no static truths, only dynamic insights, and we have to learn how to psychologically deal better with uncertainty. We have to try and rid ourselves of biases, and also when assessing situations, we have to try to take ourselves out of the equation. In closing, I'd like to say that since I stated earlier, predictions, even from the best, are notoriously wrong. We can just as well make our own forecasts. I wish you the best of luck. It's been my pleasure, and I hope that you were able to take some insights from my presentation. Thank you very much. Bye-bye.